Good morning, and thank you very much for giving me the opportunity to come and say hello to you today. My speech is about moving beyond the credit boom. It dovetails nicely in what we heard from James earlier on today. But like James, I think we're at a big turning point, a major turning point, and I want to talk a little bit about how that's going to unwind and how we all individually and collectively as savers can take advantage of those turns to make money for our long-term returns. Before I do that, I just thought I'd start by talking a little bit about Miton. For those people who don't know it, it is a very small company. It is a quoted company. It's got a PLC status. And although we are not the waterfront, we do our own little thing. Because we're small, we can do what we think is right. And not all our funds do well all the time, but we have had some early success. And very fortunately, What Investment awarded us Best Fund Group last year, during 2014, which is a lovely thing because we're up against Schroders and BlackRock, and it's lovely to get some early recognition. So what I thought I'd start with is just talking about the long-term way we all make money from shares, from equities. What we've got here is a chart over the last 5 decades, and there's 2 key bars there. The black bar is your dividend income, and the blue bar is how much that dividend income grows during the decade and produces a return. And then you've got a green bar which goes plus and minus a bit, and that's the sort of share price valuation change. And what you can see over the last 5 decades is the green bars have moved up and down, but at the end, when you aggregate it all together, the only thing that really drives return are dividends and dividend growth. It's all rather old-fashioned. People worry about sort of getting in and out of the ETFs and different parts of the market, but ultimately, when it comes to return, the start and finish is getting involved with businesses which ultimately generate a cash return, the folding stuff, and grow that over time. Of course, that's not always enough. Ultimately, that's based upon productivity. You can't get a business which actually generates more cash unless it gets productivity improvements. Productivity is the foundation of all of the success of the Western world. And a successful savings industry actually allocates capital to individual companies, not to ETFs or not to bonds and things, but down to individual companies which then use that capital to get productivity improvements, which then generate extra cash, which makes us all more wealthy. But I've also said success isn't just dependent upon getting a good company or investing in the right sector. It's also making sure that we invest with the support, the political support, the support of everyone else around us, those people who haven't got savings, because if you lose the support, as the banks have lost support, you can find that they can get very big charges, you can get very big fines, and that can ultimately stop you making a return. So the whole environment in which you're investing in is very relevant. And it's not just about making money, it's also making sure that that cash gets into things which are useful, socially useful for the wider universe. So investment returns have been excellent. We heard from James how much money you would have made in the bond market. You would have made very good money in the equity market. You've made very good money in the property market. You've made very good money in the housing market. It's been a very verdant period, and I'd like to think to some degree it's a bit like the Amazon jungle. You've got the most extraordinary range of different areas in which you can invest. That vibrancy is marvelous. Everything has made good money. And over the returns of the last 3 or 4 decades, returns have been excellent. And it's been very interesting to choose between one asset class and another as to whether it makes more money. But just about anything you touch makes money. It's a question of which makes more money than others. But unfortunately, the pattern is changing. And what we've seen really since 2008 is that productivity, the foundation of wealth generation, has changed. And if we look at this chart here, we've got 2 diagrams, but for those who can't see at the back, the first one is on the left-hand side, just shows the trend in productivity in the UK. And you can see on the right how that trend, the bottom trend, is so different from previous recoveries from the bottom of previous unsettled periods. And you can see really that over the last 8 years, the stock market may have made a lot of money, the bond market may have made a lot of money, the property market may have made a lot of money, but productivity, the foundation of all the return which we get in the markets, has not been helping. We've had productivity flat. And that is a long-term worry, because if this continues, we won't make a return going forward, or the returns will be much lower than we're normally expected to. So we've got some real headwinds coming up. This is looking at earnings per share. It happens to be in dollars. It's on an international basis. But you can see that international growth has been there, but more recently, and we're talking perhaps in the last 2 or 3 years, earnings growth has started disappointing. There's very little earnings growth coming through. So the recovery, as I say, in share prices and such like has been moving on. Valuations have been moving up, but we're not getting the earnings, we're not getting the productivity, and the foundations on which we all invest are becoming more stretched. Simple terms, it really drops. It means we need to worry about where has all the world growth gone. People worry about this because, you know, when you look at the headlines, everything is slowing down. There's a pickup in Europe with QE a bit. There's been UK has been okay, but even in the US, which is probably the most developed market, we find that actually information is very unsettled. China is also not growing as fast as it was, and so world growth is becoming more challenging. And going forward, I think it's going to become more challenging again. And this is the big question mark we've got to worry about. I like to use an analogy to talk about the opportunities at this end of the market. This is going back to the GCSE geography. This is a hill, a range of mountains alongside the sea. And what tends to happen is the wind blows in from the sea, the rain clouds come in, and when you get a hill, it forces the rain clouds higher, and they rain, because they're cooler, they rain more intensely. And so you get the rain coming in, and it rains heavily on that side of the hill. And if you think of the Amazon jungle and other jungles, this is often the case. They get extra rain because they've been enjoying the benefits of the hillside and the extra rain coming on. For those people who did GCSE geography, of course, you know what happens next, which is as the clouds move over the top of the hills onto the other side of the hill, you get something called a rain shadow. The rain clouds are largely expended, they're spent, and as they get down lower, they warm up, and you tend to find there's much less rain. In other words, there's much less growth. And in a way, I think this is where we are. I think we've had an extraordinary period of growth, extra growth really over the last 25 years, but I think we're now entering something of a growth shadow. If we look at debt, this is US debt. This is US debt expressed as a percentage of GDP. So you can see on the left-hand side, that was the end of the 1920s, 1930s bubble, which we had, and the peak out we had in debt, and how things settled down. And over the 40s, the 1950s, the 1960s, the 1970s, and indeed the first half of the 1980s, we had a lot of US growth, we had a lot of world growth, but it was at a measured pace, and it was a pace which actually was in line with debt. What we saw in the mid-80s is that we saw that debt was deregulated, and we had the extra availability of debt, and as debt became more available, that in fact accelerated growth. For the last 25 years, we've had extra debt which has boosted world growth. There was no surprise when you consider the conditions that the UK economy, up to 2008, had the longest period of uninterrupted growth. So we've been in a period of rapid growth, and the way I kind of like to phrase it sometimes is that it's like borrowing growth from the future. We've been borrowing growth from the future the last 25 years. It's been going on a bit further since then, but you can see what's happened at the end of the chart, which is debt is beginning to peak out. Banks are lending less. They're restructuring. And as they restructure, we're starting to enter that period on the other side of those hills. We're entering a growth shadow. And for that reason, we need to start thinking about what will look after our investments best beyond the 2008 credit boom. And effectively, the way I look at it is, I think world growth could be subnormal for quite some time. You know, even with super low interest rates, world growth is not accelerating. Even with quantitative easing, world growth is not really accelerating. Even though government budgets are running deficits for much longer than they ever intended, world growth is not really accelerating. And when we look at the commodity prices, when we look at the iron ore and the oil prices, the fact that these have come down so substantially in recent years tells us that actually growth expectations are changing. And with very low bond yields, effectively, we are in a position where rates of return going forward on mainstream assets are going to be subnormal, and we've got to get used to that. If we look at the last sort of 25, 30 years, this is looking at the stock market in the three different parts of the stock market. You've got in black, you've got the sort of rising share prices of the main market, the all share. In red, you've got the bottom 10%, the smallest end of the market, and in blue, you've got the tiny companies, the bottom 2%. And as I say, for the last 25 years, it's been a very good time for investing. There have been zigs and zags along the way. It hasn't been without its excitement, but ultimately, returns have been made which are very attractive, and it hasn't really mattered whether you've had big or small companies. You've been able to invest in all sorts of other assets which have been geared, such as housing and property, and investment returns have been excellent. And it hasn't been important to differentiate between big and small. A lot of index funds have done extremely well in the last 25 years. But going forward, I think we've got to talk about the investment strategies are going to need to change. I think investment strategies within institutions are going to need to change, but I think investment strategies by those who are buying funds or those who are investing directly into equities or bonds are going to need to be changed. And I think this is not just a 2 or 3 year turning point. As James was saying, I think we're at a multi-decade turning point. I think the last 30 years has been a very important period for generating returns, but I think going forward we're going to have to work a little harder and become a little bit more careful about our investment strategies. As I say, I think we're at a major turning point, a multi-decade turning point. To some degree, on the other side of that mountain, you could argue, and this is probably a bit extreme, that we're not quite an investment desert, but it's going to be a much more difficult time. If you think of that verdant rainforest I was talking about earlier, I think the investment climate has radically changed. There's no productivity improvement coming through, valuations are moving up, bond yields are very, very low and can't go much lower. So we've got to choose carefully where we invest. And that is the key important factor that we've got to keep in mind when we look at any particular asset class going forward. I don't want to be too negative. I think there will be opportunities. Even in the most severe places, you do find opportunities. I've used a little analogy here with a little kind of plant growing out of a crack in the road. But the point is, there is opportunity, but you've got to go and look for it. You've got to go know where to look for it, and you've got to be able to back your judgment in these areas. And strangely enough, you don't need to be too negative. I mean, there's some which are actually do very well. Some positively thrive in difficult conditions. If you read Taleb's books, you know, the Black Swan, his latest book is about anti-fragility. And anti-fragility is all about things which do better in adverse circumstances. And if we can find things which do better in adverse circumstances, then we will make good money for our pensions and our long-term savings. The UK stock market is not that dissimilar from many other stock markets. We have some FTSE 100 stocks, we have some mid-cap stocks, and when you look at the sectors, we have sectors like banking, we have sectors like insurance, which are dominating the indices. And if you look at European indices, if you look at US indices, you get exactly the same kinds of companies. We often have a few tobacco companies, maybe some fast-moving consumer goods like Unilever, which are also big parts of our indices. And we also have a lot of oil companies, which are a big part of our indices. And if you invest internationally into Europe, if you invest internationally into the US or Japan, you get the same kinds of factors as well. But actually, we also have something rather different. We have some small companies, but we have one thing which is really truly unique, and that's the AIM market. I know a lot of journalists are unhappy with the AIM market, and a lot of stocks have gone down, and there's been a lot of, people have lost a lot of money on the dot-coms and some of the mining and oil stocks, but ultimately, we've got an exchange which is involved in smallness. And if you look around the world for the last 25 years, when institutional interest in smallness has been declining, all the international markets which were previously involved in smallness have all died away. There used to be a Neue market, there used to be a Deuxième Marché. Even if we were speaking 30 years ago, we would be talking about NASDAQ being a micro-cap market. But it isn't. NASDAQ's morphed over the last 30 years. It's now involved in Facebook and a lot of the technology stocks at the top end of the market. But AIM, for all its negatives, is all about smallness. It's all about little companies which in themselves can buck the economic trend. And if we can get involved in some companies which are going to buck the economic trend and get productivity time when the main market's not generating productivity, we can start to make some good money for clients. So if you look at smallness, one of the great advantages of smallness is it carries with it lots of risks, lots of small companies go bust, but most particularly, the one thing about smallness is its ability to grow. It has more growth potential than big companies. Big companies, by their nature, are dominated by what's happening in world growth. And for the last 25 years, big companies have been really enjoying the growth of world growth, but now we're entering a period of uncertainty. Big companies are struggling to get growth, and they're going to have to get used to that because it's not going to change in a hurry. So if you look at those three lines I showed you earlier, with the black line being the all share, the red line being the companies in the sort of bottom 10%, and the blue line being the bottom 2%, back in the 70s, back in the 60s, back in the 50s, when the UK was actually not growing very much, you had a lot of recessions, it was a very unsettled period, those lines didn't move together, they moved apart. They fanned out apart. And that's even more amazing when you consider what we had in the UK. We had extremely difficult problems. In '74, we didn't just lose out because we had an oil price crisis. Oil prices went up 4 times, and the interest rates shot up. Inflation shot up, and that led to a lot of companies going bust. A lot of small companies went bust, a lot of large companies went bust. But you can see that red line has continued to outperform through that period. We had a lot of unsettled governments. We had a lot of coalitions and those kinds of things. It was an unsettled period for economics and for politicians as well, but it didn't stop the smallness coming through. And most particularly, we had sterling crises. It used to be that everyone used to watch for the trade figures every month, and if the trade figures were bad, sterling went down. And that you would have thought favoured the big companies, the companies with the international sales, the international operations. But even so, the red line still outperformed, the blue line still outperformed. So something very strange was happening here. And of course, what was happening was that the smallest companies were actually able to grow when the world wasn't growing. When the world's not growing, if you're a big company, you haven't got many options. If you start taking market share from your competitors, you start a price war. And if you look at the supermarkets at the moment, if you look at Tesco's and Sainsbury's, they've started taking market share from each other, and they started a price war, and both of them are losing margin. Both of them are seeing margin pressure. So actually, the great advantage of small companies is that they can invest for productivity improvement at a time when big companies don't have many options. And if they do get productivity improvement, if you do invest 20 million in a development which gives a cash payback over 3 years, you can defend your margin, you can take little bits of market share off the big guys, they're not going to attack you because they've got too much to lose in terms of their own margin, and they can actually take small amounts of growth at a time when the world's not growing, and they can get a cash payback. And the key issue about the red line, the key issue about the blue line, was that dividends were growing in the small cap end of the market. They grew faster than the main market, and that's most unexpected. It's not where institutions are expected. That's not where most people are invested at the moment. If you look at dividends, this is dividend cover. This is looking at how much earnings are exceeding the dividend payments. And this goes back to the sort of late 90s, and you can see sort of in the 2000s, dividend cover was rising. There was dividend growth in the big companies, but there was more earnings growth. You can see that big setback in 2008 when earnings disappeared for a period. There was a lot of cuts. Then the recovery with QE and dropped interest rates meant that earnings growth continued to recover for 2009, 2010. But since 2011, what you see there is that actually dividend have been growing faster than earnings. And big companies are now at a position where they can't grow their earnings, they can't grow their dividends any faster than their underlying earnings per share. And with their earnings per share not growing, you're finding the stock market is not producing much dividend growth. So there's nothing to go for left in the stock market. It may still appreciate, it may go to 20 times, it may go to 25 times. I don't know what the valuation is going to be, but you're not going to get any dividend growth. And if you remember right at the start of the talk, this is the foundation of all our returns. We need to get dividends, but we need to get dividend growth. It's all run out for big companies. There are going to be some which buck the trend. Legal & General grew its dividends by 17% this year, for example. There will be some companies which buck the trend. You can find some of them, but many more will really struggle. And that's why dividend growth across the market has run out of steam. And in a way, if you use that, going back to that sort of forest analogy, and we talk about sort of fruit as being the kind of dividends you get from your forest or from your trees, what you're going to find is actually the fruit, the best fruit in terms of dividend growth is going to be amongst the small companies. It's not going to be in the big companies where we've been. And as we move forward, it means that, of course, the investment returns are going to look very different. If you go back to Japan, and this slide doesn't really work very well, but what it's really just showing is when bond yields become very low, you just don't make a return. You might make a couple of good years and a couple of bad years, but it zigzags along, and you just get caught out by the markets moving backwards and forwards. So Japan really hasn't made much money at all, especially if you look at it in international currency terms, sterling terms, or perhaps dollar terms. And it's going to be this feature is going to be very, very slow for institutions to adopt. Institutions tend to move slowly. They're very cautious. They don't tend to jump on new trends early. So it's going to be a long time before institutions get involved in this. At the moment, most institutional investors have learned, most fund managers over the last 25 years have learned to back big companies. The top 350 companies has been where all the money's been made. And they're very reluctant to come down to these small companies. But they will, over time, as they underperform, as they miss out on returns, they will find that actually they have to move down. Because the returns, although it might look quite good to have 76 times your money from the big companies in this period, inflation-adjusted returns were almost nothing. So there's very little money, there's very little goodness made in the mainstream markets. What you've got to do is start embracing a wider universe of small and micro-cap companies. And boy, do we have a lot to choose from. This is looking at different parts of the market. So the bar on the right is the billion-pound companies. And you can see in number terms, there's about 230, 240 billion-pound companies in the UK market. The next bar on the right, the sort of second bar on the right, is 300 to a billion-pound companies. And that's most of the mid-caps, a few small caps, and there's about 180 companies. But as you move to the left, you can't start getting into the very small areas. The third bar from the right, you see, is about 100 to 300 billion-pound companies. These are companies which are quite small, very few institutional investors. And then you get into the sub-100 million-pound companies, the 50 to 100, there's about another 160, 180 companies there. Down to 25 to 50 million-pound companies, there's probably another 190 companies there. And then once you get below 25 million, would you believe it, including the ISDS listed stocks, including some of the main listed stocks, but mainly AIM listed stocks, we've got between 600 and 700 quoted companies which are below 25 million. That vibrancy, that investment opportunity, those inefficient pricing of companies means that you individually can get around and choose individual companies which hopefully are going to buck the trend. Now, be careful not to just choose one or two. You've got to have a good spread of these because quite a few of them will disappoint. But on average, this is going to be the best performing part of the market. And we are privileged, we are lucky, we are so fortunate within the UK to have the AIM market on our doorstep. As I say, the AIM market is almost unique in the world. There is very little other things in the world where you can get smallness and the ability to buy and sell. There are some pink sheets in the US which deal in pink, in stocks, microcap stocks in the US. And strange enough, in Japan, there is quite a lot of small companies quoted in Japan too. But then, of course, Japan has not grown for 25 years. And the whole point is that this is to buck the fact that world growth is stalling. And we can, as an individual, as a society, collectively, we can put a bigger part of our savings into these microcap companies. They can generate returns, they can generate productivity improvements, they can generate cash, they can buck the economic trends, and they can pay dividends when big companies aren't growing much. So to some degree, this brings in the advantages of biodiversity. If we were just relying on the top 350 stocks, the same kind of sectors you've got in other markets around the world, you kind of expect the same experiences in other markets around the world. So if you happen to have European markets, or if you happen to have US markets, they will broadly do the same kinds of things. What you've got at this end of the market is you've got tiny companies, you've got a much wider range of industries, you've got a much wider range of individual stocks, companies which can grow even when the world's not growing. It may look different. I've deliberately chosen a slide here which looks a bit like a sort of deserty conditions. As I say, there's not going to be much rain around, there's not going to be much growth. But these companies can nevertheless, some of them can survive, some of them can prosper, some can actually thrive in these conditions. And if you can identify those companies, you will make, hopefully, a very attractive return relative to the main market. And many of these companies will go on to generate returns, not just in terms of share price, but particularly in dividends. If you can get companies which grow from low dividends to high dividends over time, that will drag up your share price. And if you drag up your share price, you don't just make the returns on the cash you get from the dividends, but you make extra capital return as well. So these returns might look a bit different from the ones you've received in the past, from all the big companies, but not all small companies, but a large number of them. If you can identify companies which have good balance sheets, good productivity, the ability to produce a return against the market, then income will be a big part of that long-term return too. And in fact, to some degree, I think we've already started on this pattern. It's not well recognized. Very few people think it's going to last. But you can see in red, the small companies index has outperformed versus the black line, which is the FTSE 100, or the mid-cap, which is the blue line, which has been the most popular market for the last 15 years. I think the red line will continue to outperform, but I think particularly the AIM market is going to be the best part of the market. So there's lots of AIM companies here today. There's some companies which are even pre-float companies. Have a look, have a spread. Some of those companies are going to be able to buck the trend and produce a return when the main market runs out of steam. And of course, the real advantage isn't just that we deliver an attractive return. It isn't just that we get good and growing income out of companies which, as they grow, they become more mature. But most particularly, these companies are often socially useful. They're socially useful because they generate employment. They're socially useful because they generate domestic growth, extra growth for the UK economy. And they're socially useful as they make profits, they pay corporate tax. They're not all based in the LLP, wherever it is the LLPs operate from. So the great advantages they have the political support as well. So it's not like the banking sector where you'll find the politicians are against you. At this end of the market, the politicians are in our favour. And it doesn't matter which government is going to be in power, they're pushing in this direction. That's why when you buy and sell AIM stocks, you don't pay stamp duty. That's why AIM stocks are now included with ISAs. And if we can get more political support, perhaps there'll be other tax incentives like IHT benefits, which also come with the AIM market. So don't put all your assets in one basket. Don't put all your shares in one company, but have a spread. But at this end of the market, you are ahead of the institutions. You are ahead of the market. And what you'll find over the next 5, 10, and 25 years is that this actually turns out to be pretty much the best performing part of the market. So with that, my conclusions are, we've had some extraordinary periods of boom years. Investment returns have been outstanding. QE has even boosted equity markets even since 2008 without productivity improvement, and now that growth is slowing, markets are right up there. But as we move beyond the credit boom, it's now time to really widen your investment universe. Don't rely on those big companies. Don't rely on those ETFs. Don't rely on those index funds. Get involved in a lot of small companies. And we're just so lucky to be sitting on the equivalent of the gold mine. We've got the AIM market. It's right round the corner. It's almost unique in the world. It will be attracting companies not just from the UK. We're seeing American companies come into the market. We're seeing Israeli companies, lots of international companies. And that's going to be good not just for our savings. We're not just going to make better returns at this end of the market, but we're also going to be boosting other factors such as employment, such as domestic growth, such as dividends ultimately. Thank you very much indeed.